no judgment if you guys want to use this time to grab a beer. I heard it's almost last call. Morgan's been trying to convince us to do shots every time somebody says RWAs. Turn this into a drinking game.
Spite. Bhaji, we were saying one hand TradFi, one DeFi.
Yeah. We can do beer every time someone says TradFi and tequila every time somebody says DeFi. You see how we end today.
There we go. Maybe we'll do it ourselves.
I like it. So really excited to be here. I am the CEO of Centrifuge, but we're also the producer of the RWA Summit. So we partnered with the Tie to bring the two events together. They've been to a few of ours. We've been to a few of theirs. There's such an incredible overlap, of course, between RWAs and the institutional conversations that we're having today. So I'm wearing my RWA Summit hat today in the moderator seat and really excited to bring a lot of these folks together to have a conversation around the integration between TradFi and DeFi and what we're seeing for RWAs, what's been done, and most importantly, what still needs to be done. Okay. Not sure if you guys saw the prep question, but
I did not.
Starting
What? Negative.
with something a little different here. So we're going to do a round robin. And what I want to ask, and you guys got lucky with the seating order, is where is the ideal state of TradFi and DeFi integration at a certain time period? And then what's the biggest blocker for that to happen? So Colin, you are at the end of this year. Morgan, you are at the end of Trump's term. Charles, you're at 10 years from now. And then JD, you're like the future state. So what does DeFi and TradFi integration look like? And then what's the blocker for that to happen?
I got the easiest one, guys.
Yeah.
All right, wait, so I'm going first.
Yeah, so by the end of this year, where are we?
Okay. The biggest issue we have right now is that we're all still playing around with money market funds. And we need to be moving out the risk curve a little bit. I think stablecoin proliferation is easily my biggest fear right now because the word stable is being stretched every way. I don't even know what stable means anymore. But I think the biggest blocker is that we don't have net new liquidity coming on chain right now. And I don't think it's because and I'm not sure exactly why that is. But I think it's because, in my opinion, TradFi is still trying to hold on to the existing module or kind of ways of working that they've always held on to and haven't really yet taken the next step to dive into what it's going to take to be successful in kind of a public and open blockchain-based ecosystem. That's my take.
So stablecoins by the end of the year, biggest blocker is TradFi capital coming on chain.
Yes, and I think we have a massive some kind of stablecoin headline that dramatically sets us back from getting net new liquidity on chain in the next 6 to 9 months.
Bad.
Yeah, it sucks.
Can you hear me? Oh, hi. So it's interesting you say, what did you say? Like institutional liquidity is still not here.
Net new liquidity, right. We're just recycling.
I think it's because we suck as an industry.
All right.
There's not enough similar institutions to access tokenized assets to date.
Wait, is this your take now or is this the 10-year take? Those her time or else.
I'm after Trump's term.
Oh.
So after Trump's term, I think we will have a much clearer stablecoin regulation frameworks. And I think that we will start to see more traditional /Web 2 firms like neobanks, fintech startups, embedded finance platforms start to adopt stablecoins as an enabler in their back end. So starting to see this off-chain liquidity come on-chain through these integrations with traditional distribution channels, i.e. these Web 2 challengers, if you will, which I think will set us up for kind of the future in terms of greater adoption. But those are some of my predictions.
And that's 4 years?
In 4 years.
And the biggest blocker for that vision to become reality?
Well, I think that we need to make it as easy as possible in order for these integrations to happen and to increasingly abstract away a lot of the complexities that are that come along with accessing things on chain. I think we'll get there, and I think we're starting to see it. But to date, I mean, a lot of those blockers have been just like, it's just like annoying to access the on chain. There's no reason to for a lot of people.
So suck less.
Suck less.
Charles, 10 years.
10 years from now, where we'll be. So I think private markets will maybe partially or totally run on chain. Private market is the one that can really benefit from blockchain, reducing, like removing the intermediary, reducing the reconciliation time. I'll be a bit controversial and I'll say that real estate is still not on chain. I think it's one of the very hard use cases where tokenizing mortgages will be a thing, and it's already starting to happen now. Now, tokenizing the actual ownership will probably exist, and I hope there'll be some kind of use cases where instead of having a piece of paper, you'll have the deed on the blockchain. Now, the fractionalization of USDs to provide investment through fractionalization in real estate, I think it's really hard to justify when you compare to just what a REIT can do. I think there's a lot of, there will be tokenization of equity. I heard a lot about that today. It will take probably 5 to 10 years to be fully executed. Then indices are coming on chain also. There are, of course, the classic tokenized ETF will be something that come first, but I think you'll have the possibility to have maybe NFT-like wrapper that have the underlying within them, or allowing for some type of arbitrage and that kind of thing. Fractionalization will be more developed. Right now, we don't have that many use cases where fractionalization is that amazing, but there are a lot of use cases. So the tokenization of, the third floor of Macy's and the revenue from that floor, the tokenization from the water and sewer kind of T-bills, the munis, that can be fractionalized. So you'll have a possibility to invest, $10 in something that gives you exposure to all the Blue City water and sewer munis will be there. And again, of course, all opinions are my own and not of my employers. It's pretty hard to say what will happen in 10 years, but there'll definitely be more and more institution involved. And I think, and again, that's really my opinion, I think there'll be public chain will prevail.
Okay, and JD, paint the beautiful future state for us. Why are we all here?
I've got the best job of everybody because all of our dreams are going to be realized by the time that happens. Things like ETFs, things like mutual funds, those terms are going to disappear. We're going to forget things, blockchain transfer funds. Like Colin said before, we're not going to mess around just with portfolios of treasuries, but commodities, equities, and all sorts of other instruments are going to be there. I think you're going to have a rewrite of the way that the banking system works. You're going to have the ability for folks internally to use blockchain technology potentially attached to the core, which is a key function for banks, as we all know. It'll allow for things like symbol transfer, collateral management, to treasury management, all to be blockchain-based. Interconnectivity between different geographic regions is going to be beautiful. We're going to be mitigating risk across the board and not endure without transparency or time. We're not going to worry about things like weekends because we're going to have the ability to go ahead and transfer real time in a transparent way. It's going to be a beautiful place that we're all going to want to live in.
I think we should just end there. All to bed. Okay, I'm going to kick it back to you, JD, and bring it back to this year. One of the challenges Colin mentioned is just the commoditization of treasuries. There's a ton of tokenized treasury issuers, and the demand is capped in terms of what the growth potential looks like. As an asset manager, I know obviously you guys have and had one of the very early tokenized treasury funds. What do you think of in terms of your roadmap, and what are you seeing for the demand side of what you might want to tokenize and bring on chain next?
Yeah, it's a good question. So I've got a thesis, and the thesis is simply that we can't provide the industry with just simple instruments or funds, right? We got ourselves, obviously, Arca created a treasury fund in 2020. BlackRock, Wisdom Tree, Franklin, and others have all come forward with that. And there have been varying degrees of success as we've seen so far. But I think that the learnings that I have in the 45 years now since we created the first 40 Act fund to issue shares on digital asset securities is that you can't simply give a product out to the market, right? And I think that BlackRock gets props what they did with BUIDL. I think it's a great thing. And I think it's really just taking huge steps in terms of really bringing credibility to our space by having brand names that are coming in and offering products. But I think if you look at the AUM of their product, they were at something like half a billion or $600 billion. And they're really down at about half of that at this point. Yet there have been really interesting announcements by FalconX, who's accepting, that token as collateral. But the lesson I think that I've learned, and I think many have learned, is that you can't provide folks with an instrument. You need to provide a scope solution. So taking an instrument and attaching it to a technology and allowing for it to be delivered and telling people, if you actually log into the system, ignore the fact that it's blockchain-based and use something like a tokenized treasury fund for transference, for settlement, for all these different access points to exchanges. I think that we're going to be a lot more successful as an industry because the lesson's been that you can't just allow people to do it.
That tees you up, Colin. Well, you guys obviously are talking to almost every major asset manager, talking about what that cross-chain functionality looks like and creating more composability across the DeFi ecosystem. How are you seeing the optionality of where these funds launch and how they can create connectivity without fragmenting liquidity?
Well, we're not the only one talking to all the asset managers. I think all the asset managers are talking about all of us as well. They're doing a lot of research. They're doing a lot of information collection and trying to figure out the right entry point into the market. I do think interoperability, if I have like a 10-year view, I think it's probably one of the bigger things holding us back. I don't think it's fixed in the next year, and there's a lot of different people out there trying to solve that. I don't think it's DeFi native only. I think one of the major problems is the existing financial market infrastructure that exists today and how far behind it is versus what we look at in a smart contract-based or a blockchain-based world. So a lot about what we think about at Chainlink, we've released something recently called the runtime environment. We're trying to actually build the connectivity between the existing off-chain technology that exists and how do you plug that into the existing on-chain world that's being built today. And I think all of us in this room, specifically at crypto conferences, far underestimate or just don't remember in moments like this just how big that gap is on a pure technology play basis. And so I think that's a key component. When it comes to on-chain, I think interoperability is still a big piece of a big problem, but I don't think it's nearly as big a problem or as nearly as big an opportunity as kind of what I was driving at in my first answer, which is if you want to get net new capital on chain, you actually have to go off chain and upgrade the existing financial market infrastructure that exists today. And we do a lot of that work at Chainlink, and it's pretty under the hood, and I would say not rewarding. It takes a long time, but I think that kind of stuff leads to net new capital inflows over the long term for all of us.
Yeah, and I think a lot of it is the sophistication, the infrastructure, the work around the product and the technology, not just the technology. So Charles, I want to kick it to you. How are you guys thinking about ratings for tokenized funds, and what is your view from the S&P side of how you can bring some of that trust and credibility to the on-chain markets?
Sure. So first and foremost, in case you're not aware yet, I've been saying that at many forums in the past, but people are still surprised. Tokenized asset can be rated in most of the cases, especially when we're speaking of financial instrument. The risk of the tokenized asset is not necessarily the same as the underlying, even if it was already rated. And I think maybe for the audience, it's interesting to share like what I see from kind of my vantage point. The demand has increased a lot. So when you do rating, you can have it in three different dissemination, we call it. Can be private, confidential, or public. So if you heard about rating, it's because it's public. But there are many rating right now being done that are either confidential or private. You can switch from one to the other. So if you start with product and you're not sure what will happen with your rating, you can start with confidential and then you convert it to private when you want to share it with whoever fiduciary institution that asks for that. 2 years ago, or 3 years ago in 2022, the interest related to just risk assessment in general was very low. Now it's everywhere. So we are reached out for rating. So we have a specific product, which is a risk assessment of the potential risk of depeg of stablecoin. But aside from that, we are looking at rating of stablecoin, yield-bearing stablecoin, tokenized treasury, tokenized money market fund, but also now more and more tokenized CLOs, tokenized product with Bitcoin as a collateral, because all the big private credit firm have a lot of clients with a lot of Bitcoin and they want to get a yield on that. There are products that are being built that can be rated. So the demand is really increasing. The way we look at it depends almost case per case. For stablecoin, the assessment on DPEG, we have a specific methodology for that. Now, for all the other tokenized assets, it really depends on what is the structure and how it was set up. So, for instance, even for the rating of a stablecoin, all the stablecoin are made differently. So it's really case per case, and we'll assess first, is it rateable? And then which methodology would be used. Sometimes seem like a fund, sometimes seem like structure of finance.
And then also on so we've kind of talked about the technical side of the funds, bringing them on chain, and then moving to the practical side and what's next. So it seems a lot of the question is around distribution and liquidity being a key focus and a key driver. Morgan, I'm curious for you. I know when you guys launched L1s, it was all private. Now it seems like there's more of a pull on the institutional side for public blockchains. How are you seeing the shift of the conversations that you're having with the institutional clients that you're talking to?
Yeah, I mean, I think I said this in your earlier panel, like, sorry if this is repetitive for anyone, but I think, 7 years ago, when a lot of institutions were making their first foray into kind of leveraging DLT for different use cases, the only options were public permissionless like Ethereum and like private permission enterprise chains like a Hyperledger or Corda. And there were no hybrid options. And I think since then you see the advent of whether it's Cosmos or Avalanche or others that kind of allow not just institutions, enterprise government agencies, large Web2 platforms, ready purpose-built application to really kind of get the best of both worlds and be able to kind of control and own their end-to-end and optimize their end-to-end blockchain environment, but still be able to benefit from the DeFi primitives, innovation, native integration, stablecoins, Oracle feeds that exist on public permissionless networks and kind of reap the best of both. So I think especially after the election in the U.S., we are seeing a greater and renewed excitement around institutions leveraging public blockchain infrastructure, but in a way that kind of allows them to meet the risky control parameters, but still be able to tap into like all the innovation had to be on public chains.
Do you think we'll start to see consolidation of public chains and not centralization, but more focus on some winners as it relates to public chains?
I mean, I think if you ask anybody, everyone will believe in a multi-chain future. Like, I don't think that's kind of debatable, but like, do we necessarily need net new networks that take some part of an optimization of like the EVM or other chains? Like, sorry.
Let's make it spicy, Colin.
I'll take the other side of that. And the reason I will is because institutions need carry and they need upside exposure to DeFi and what's happening in the on-chain systems. So in my mind, the only way institutions are getting that exposure is they're picking a new blockchain, they're allocating through their venture arm or some innovation arm to that blockchain. When it explodes, they sell, and then they use that blockchain for some institutional issuance. So I think we're going to continue to see blockchains do that as a pathway for institutions to get exposure to the space and test the technology.
Well, I also think you have to define what you mean by institution. Like, I don't necessarily see certain banks or asset managers YOLOing into new chains, but venture funds, yes.
Pre-Trump or post-Trump?
We'll see. But I do think, and we were talking about this earlier, I think if any application reaches true product market fit and awareness and adoption, they will want their own chain. Whether that's an app like L1 or Cosmos or other type of ecosystem, I think we'll increasingly start to see people wanting their own purpose-built network that, importantly, is natively interoperable with other networks. But I think we'll start to see that shift.
JD, from the Arca asset management perspective, how do you view multi-chain?
Yeah, I mean, I think I look at it, I think about from the institutional lens, I think about how banks will look at it, right? I think that, the lesson that I think that Hypebeast learned, that banks are not to be full control with public blockchains. We've got this conversation to be for 5 or 6 or 7 years. I look back at the work that was done, at Project Guardian, which then demonstrated that you can have multiple different private fiduciary blockchains that are out there with reliable bridges that allow for the confidentiality that's required by banks and that allow for the transparency you're operating through it too. I also think that there are other examples whereby you can have them working hand in hand, whereby you could take a fund, for example, like an issue shares, and the shares of that fund could be transferred on a private permission blockchain as well. And when you do something like that, it provides a couple of different key elements, right? It provides, first of all, checks and balances between what's happening on the private blockchain and the transparency that's then delivered to the public chain. But the other thing it does that it allows for folks to actually handle large multi-million, hundreds of million, billion-dollar transactions and have the confidentiality they need in order not to move markets, which is also the other problem that you also have to encounter for. So I have to believe that, there's going to be a world where there will be, kind of harmony that exists with, kind of many different private chains that are out there. And I think there'll also be multiple different public chains that are out there as well. I think the original thought, 18 and 19 was that you would have certain chains that would, whereby certain industries would gravitate, right? Tezos was starting to become the financial blockchain back then, right? But I think the history showed that, kind of there hasn't been any sort of critical success in someone trying to target one specific industry and the industry themselves embracing.
Charles, from the rating perspective, what are some of the risk factors that are weighed most heavily? Do you view multi-chain as a risk factor? Do you kind of think about how these tokenized products are structured, what the underlying asset looks like? How do you kind of build out what that rating is?
Okay, so just as disclosure, I'm not part of the analytical side to a really firewall. That said, in the different assessment that we have, they are looking at everything. So rating is probability of default. So they look at everything that could lead to a default. If you're multi-chain and something happened to a chain, but it doesn't necessarily lead to a default, they'll definitely look at this. Just want to touch on the previous question very fast. Through my role, I speak with a lot of different banks and blockchain that are, issued by banks. What's interesting that in closed rooms, they all agreed. I was very surprised, of course, I cannot say a name, but the end game is public. Maybe public permission, not looking at that. But you got some very big players that have very big private blockchain, and you would expect them to think that, well, that's what we're doing. But many of them are actually US banks that are innovating abroad because they had to, be it in the UK or in Singapore. And, we were speaking about the different timeline, but this new administration, if they can get the regulation right, by that I mean not like MiCA, which is too restrictive, it's going to change everything. And then you'll have this adaptation on, now I know the rules to actually touch public chain and what can be done, permission or not. And then I think there's one more component which will be extremely important and is kind of in the conversation but not fully there, and it's VK proof and the privacy that can be enabled through that.
Colin, maybe pulling from some of your time at Centrifuge, but also now at Chainlink, it's not that exciting just to tokenize the asset. There's what happens next. How do you integrate it into DeFi and create more utility and have a more composable system? How do you view the net benefit of having an asset tokenized and having it available on-chain than what's currently available in the off-chain markets?
I think we're still developing this as a industry broadly, but I mean, obviously atomic settlement is kind of the first thing that comes to mind. I think you start to think about ways you can do settlement on payment with different asset classes and different token types, I think is incredibly compelling. But I really think the two pieces that are standing out right now are collateralized trading and collateralized lending. I do think, and I've kind of got consistent in this messaging, is that I think where we're going is we have to figure out more utility for these assets within the on-chain system. And to that point, I think the on-chain system needs to expand and who's actually using it and what they're doing with these things. But I think those last two are just everywhere I turn. That's where I'm seeing, how do I do more collateralized lending against these assets? What kind of assets am I lending against? And then what can I use those? Can I put those up for collateral within a trading environment as well on exchanges?
But Colin, picking up on that, I mean, one of the biggest problems I think that exists right now is that the guys that are doing that in the biggest possible ways are prohibited exploring that. And, we had an example of we were working with one of the biggest U.S. banks that's out there. It was top 5 bank. And the lengths that we've had to go through in order to demonstrate collateral movement at a bank has been just frightening. Taking a token, kind of finding out a third-party way that you could pull off the attributes of it, having it have no value, wrapping it, putting it to another custodian because they can't custody it, trying to create a private permission infrastructure that they could call their own and try to replicate the functions that are there. It's real hard how to get that experience. And I push it back to you is how do we bridge that gap, right? How do we get to a point whereby you've got the confidence that these large institutions can do things and not have to go offshore and can actually, deploy, real-time environments that are so hypothetically that it allows for real voting that also names the building blocks for what going to production.
Well, if you think about like collateral management in a traditional bank, you think about the amount of collateral, right? The total amounts that they're managing versus what we're managing on chain today. I don't think the juice is worth the squeeze right now, right? So when you think about like we can show them a use case and to your point, they'll go, oh, that sounds so hard. Look at all these technical pieces, these hurdles. But if you look at like internally within a bank and how they manage collateral within the system that it is today, it's also terribly inefficient as well, right? So you have this massive gap between the technology state and the size of the liquidity that's on chain today versus the size of the liquidity and how inefficient it is off chain today. So they know this needs to improve, but they know that what we've built today is just not yet sufficient.
So is that a 1 year, 4 year, 10 year, or a hypothetical future year?
Morgan, over to you.
I was going to say, Colin, we're here for your super top. My mom told me I'm doing God's work, so I think part of it is also like these large banks and us, especially banks. They're the result of years and years of M&A and systems that don't talk to each other, and they have many, many years and billions of dollars to tempt it. So in here, they're just going to be much slower to move. And therefore, I think that there's actually a very big opportunity for more tech-forward challengers out there that are kind of the fintech platforms of today who are looking at tokenization, stablecoin, smart contract, blockchain as a way to enter new markets and as a way to do so that's economically feasible for them and to kind of grow their moat and gain that competitive edge. So I know we always talk about eDeFi, like, so you tokenize it, so what is the utility? But I think that's taken for granted the fact that offering dollars to people in emerging markets, offering U.S. equity exposure to people and outside the U.S., that exposure that can be kind of given to them at a much lower cost by the institution as offering, that is a utility in and of itself. And that is a way, I think, also to bring in net new capital into the space who frankly doesn't know or doesn't care that they're using blockchain, but now they have access to dollars or a yield-bearing savings account. So that's the part that in the interim I'm really excited about because it can be driven forward by Web 2 companies, but maybe those that are not necessarily as overburdened by the large banks out there that just inherently are slow.
Colin, final word? I think that was a good question. It got some crosstalk here, which is what we're going for. But yeah, I mean, a big part of it is who's the user, who's the customer, where are we distributing those products? And then from that, what's the use case working backwards? We are at time, so I'll do one more quick round robin back to the time horizons. Where do you think we'll be in terms of total TVL for tokenized assets by 2030?
Where is it today?
Well, do you count stablecoins? Let's just do our tokenized treasuries, RWA is like 2 billion. So we have a McKinsey report that says 2 trillion by 2030, and we have a BCG report that says 16 trillion by 2030. So what do we think here on this panel?
JD, you go first.
I'm the ultimate optimist here, so you guys know where I'm going with it. I think that if we could figure out some of the challenges that exist, perhaps within 30 years. I mean, in 30 years, how old are we all going to be, right? Well, I have to imagine in 30 years we're going to solve that. So, I mean, my guess is that whatever the financial system coupon is at that time is going to have to be the answer. If they're talking 30, my God, maybe more global. I have to go. I'm taking
400 trillion.
Go for it.
So when in 10 years, like
30 years.
30 years?
By 2030.
2030. Okay, so 5 years. So it's really hard to say. I think usually people tend to like overestimate the speed of adoption and then in the very long term underestimate what it can be. We saw that with the internet and other stuff. But here we've been in this field for a while. Institutions are not hearing it about it for the first time. By 2020, by 2030, I think it's possible. But it depends what you include. If you include the Bitcoin and everything,
We need a number.
7 trillion.
7 trillion. Okay, you have it here.
Yeah, I was gonna say 8, but I would just also say that there's like a nuance in terms of the amount of that's tokenized, right? Like there's an amount that's tokenized that uses the blockchain as like the legal kind of recourse and like marker of ownership. Then there's market cap, which is people actually like buying the asset, and then there's TVL, which is being locked in a smart contract for like borrowing purposes. So there's we have to like get to qualify some of those things, but I think if you're just looking at like on-chain, like representation of like legal recourse, a lot higher. And then as you go down to TVL, probably a fraction of that.
Colin.
I'd probably go, if we're at 2 billion now, 5 years, we're probably at over $1 trillion in real-world assets.
All right. Good stuff, guys. Thank you so much.
Thank you.
Yeah.
Thanks, guys.